For entrepreneurs, securing funding is vital. It breathes life into their ventures. Understanding venture capital is no longer optional, it's a necessity. This guide will equip you with the knowledge to navigate this complex world. Based on the book, this guide will break down raising venture capital. It will demystify the process. You will learn how to secure the best possible deal. Venture deals are more than transactions, they are partnerships. Understanding the intricacies of these deals is crucial. It can make or break your startup. This guide will be your roadmap. It will help you confidently navigate the world of venture capital. Let's begin our journey to securing your company's future. In the world of venture capital, several key players drive the process. These individuals and groups are essential in shaping the future of startups and innovation. Understanding their roles is crucial. Each player brings unique skills and resources to the table. First, we have the entrepreneurs. These visionaries are the driving force behind new ideas and innovations. They are the heart of the startup ecosystem. Without their creativity and determination, new ventures wouldn't exist. Driven by passion and innovation, they seek capital. This funding is essential for turning their ideas into reality. They aim to fuel growth and bring their ideas to life. Their journey is often filled with challenges and triumphs. Next, we have venture capitalists, VCs. These are professional investors who play a pivotal role in the startup ecosystem. These are professional investors managing large pools of money. They carefully select startups with high growth potential. They seek out high-growth startups. Their goal is to invest in companies that can provide significant returns. They provide capital in exchange for equity. This partnership helps startups scale and reach new heights. VCs often guide and mentor the companies they invest in. Their experience and networks can be invaluable. Angel investors are also important. These individuals often invest in the very early stages of a startup. These are individuals who invest their own capital in early-stage companies. They take on significant risk for potentially high rewards. They often play a crucial role in providing seed funding. This initial investment is critical for startups to develop their products and services. This helps startups get off the ground. Without angel investors, many startups would struggle to survive the early stages. Finally, we have lawyers and advisors. These professionals ensure that all legal and financial aspects are properly managed. These individuals provide legal and financial expertise. They help navigate the complex world of business regulations and compliance. They help structure deals, negotiate terms, and ensure everything is above board. Their role is essential in protecting the interests of all parties involved. Fundraising is a crucial step for any startup. It requires a strategic approach. This involves understanding your funding needs, identifying the right investors, and crafting a compelling narrative. Timing is everything. Raising funds too early or too late can be detrimental. It's about finding that sweet spot where you've gained some traction, but still have room to grow. Pitching to VCs is an art. Your pitch deck should be clear and persuasive. It must articulate the problem, your solution, the market opportunity, and your team's expertise. Don't forget to include realistic financial projections. Once you've piqued their interest, you'll encounter the term sheet. This document outlines the key terms of the investment. Understanding its components is crucial. The term sheet is a blueprint for your investment deal. It sets the stage for the future relationship between you and your investors, laying out the fundamental terms and conditions. It's a non-binding agreement outlining the key terms. While it's not legally enforceable, it serves as a critical reference point for drafting the final binding agreements. Think of it as a roadmap for your journey with your investors. It guides you through the various stages of the investment process, ensuring everyone is on the same page. One crucial element is valuation, how much your company is worth. This is often the most debated aspect, as it influences the equity stake the investors will receive. It's expressed as pre-money valuation before investment and post-money valuation after investment. Understanding these terms is vital for both parties to agree on the company's worth. This dictates the equity percentage the investor receives. Then there's liquidation preference, which is another key term. It outlines how proceeds are split if the company is sold or liquidated. This term ensures that investors are prioritized in the event of a sale. This ensures investors get their money back first, protecting their investment. It's a safety net that reassures investors about the security of their funds. We also have participation rights. These rights allow investors to continue benefiting from the company's success, even after they have recouped their initial investment. This allows investors to receive a portion of the profits beyond their initial investment. It's like a bonus for their belief in your company and its potential. It's like a bonus for their belief in your company. This can be a significant motivator for investors to support your business. Control terms are also crucial. These terms define who has the power to make important decisions within the company. They determine the decision-making power within the company. This includes who gets to sit on the board and how voting rights are distributed. This includes board seats, voting rights, and protective provisions. These elements ensure that both the founders and the investors have a say in the company's future. Section 5. Valuation and ownership, the foundation of the deal. This section is pivotal for understanding the core elements that drive successful venture deals. Valuation is the foundation of any venture deal. It sets the stage for negotiations and determines the potential for future growth and returns. It represents the worth of your company, encompassing all its assets, intellectual property, and market position. Determining a fair valuation is crucial for both entrepreneurs and investors. It ensures that both parties feel confident and secure in the deal. Pre-money valuation is the company's value before the investment. This figure is essential as it influences the percentage of ownership the investor will receive. It's based on factors like traction, market size, and team experience. These elements collectively paint a picture of the company's potential. Post-money valuation is the value after the investment. It reflects the new capital injected into the company and its increased worth. Ownership is another crucial aspect. It defines who controls the company and how decisions are made. When you take on investment, you're essentially selling a piece of your company. This transaction must be carefully considered. This dilutes the ownership of existing shareholders, including founders and early employees. Understanding dilution is vital to maintain a balanced ownership structure. As you raise more funding, your ownership percentage will decrease. This is a natural part of the growth process. It's a trade-off for growth capital and the expertise investors bring. The right investors can provide not just money but also valuable guidance and connections. Negotiating a fair valuation and managing dilution is a balancing act. It requires careful planning and a deep understanding of both the market and your business. It requires a clear understanding of your company's worth and your long-term goals. By aligning these elements, you can secure a deal that supports sustainable growth and success. Section 6. Liquidation preference and participation rights. Liquidation preference dictates how proceeds are distributed if the company is sold or liquidated. It's a crucial aspect of protecting investor interests. A one-times liquidation preference means investors get their initial investment back first. Anything beyond that is distributed among shareholders based on their equity. Participation rights add another layer to the equation. They allow investors to receive a portion of the proceeds beyond their liquidation preference. This can result in a larger payout for investors. Negotiating these terms is crucial. You want to ensure your investors are protected, while also safeguarding the interests of founders and early employees. Understanding these terms is essential for making informed decisions during the negotiation process. It's about finding a balance that aligns everyone's interests. Section 7. Control terms. Navigating decision-making power. Control terms determine how decisions are made within the company. They outline the governance structure and the influence investors have. Board seats are a significant aspect of control. Investors often take board seats, giving them voting rights and a voice in strategic decisions. Voting rights dictate how much say each shareholder has in company matters. These rights are typically proportional to equity ownership. Protective provisions give investors veto power over specific decisions. This protects their investment and ensures key decisions align with their interests. Negotiating control terms is about finding a balance. You want investors involved but also need the freedom to run your company effectively. Section 8. The art of negotiation. Securing favorable terms. Negotiating a venture deal is an art form. It requires preparation, knowledge, and a willingness to stand your ground. Remember, the first offer is rarely the final one. Understanding your leverage is crucial. This comes from factors like traction, team strength, and investor interest. The more leverage you have, the better your negotiating position. Hiring a good lawyer is essential. They can navigate the complexities of term sheets and ensure your interests are protected. They're your advocate in the negotiation process. Don't be afraid to push back. If you're not comfortable with certain terms, voice your concerns. Negotiation is a two-way street, and both parties should feel good about the outcome. Section 9. Building strong post-investment relationships. Securing the deal is just the beginning. Building strong post-investment relationships is crucial for long-term success. Communication is key. Keep your investors informed about your progress, challenges, and milestones. Regular updates and open dialogue build trust and transparency. Collaboration is essential. Your investors are your partners in growth. Leverage their expertise, network, and guidance to navigate challenges and make informed decisions. Remember, a successful venture deal is a partnership. By fostering strong relationships with your investors, you create a solid foundation for growth and mutual success. This journey requires careful consideration, expert advice, and a clear understanding of your goals. With the right knowledge and approach, you can secure the funding you need to turn your vision into a thriving reality.